There is a single word, rarely spoken but constantly practiced, that separates the legendary investor Warren Buffett from nearly everyone else. It is not value, or moat, or compounding. Those are merely the results. The word itself is the cause, the engine of his discipline, the gatekeeper of his immense fortune. It is a word that, once you understand its profound power, will fundamentally change your approach to every financial decision you ever make. It is a word that acts as a shield against the noise, the hype, and the foolishness of the market. That word is no, but not just any no. It is a specific, systematized, and ruthless no. It is the sound of a difficult idea, a complex business, a speculative frenzy being tossed onto a pile he calls, with characteristic simplicity, the too hard pile. Most investors believe their job is to find the yes. They hunt for it, they chase it, they spend thousands of hours trying to conjure it out of thin air. Buffett understood early on that his true job was to say no to almost everything, preserving his time, his focus, and his capital for the rare, obvious yes. The world bombards you with thousands of publicly traded companies, each screaming for your attention, each promising to be the next big thing. The average retail investor, and even many professionals, feels an obligation to have an opinion on all of them. They feel ignorant if they can't speak intelligently about the latest cloud software company, the revolutionary biotech firm, or the disruptive fintech startup. This feeling, this pressure to know everything, is a trap. It is the single greatest destroyer of wealth for the individual investor. It leads to a portfolio built on shallow knowledge, headline chasing, and a constant, nagging anxiety. It spreads your most valuable asset, your finite mental energy, so thin that it becomes useless. Buffett's too hard pile is the ultimate antidote to this poison. It is an admission of humility, but an act of supreme confidence. It is the understanding that the secret to winning in the stock market is not to play every game. It is to choose to only play the easy games. This is not about being lazy. It is about being a professional. A professional tennis player doesn't try to hit a winner on every single shot. They focus on getting the ball back over the net, waiting patiently for their opponent to make a mistake or to serve up an easy high-percentage shot they can put away. The too hard pile is how you let the market serve you that easy shot. You will learn to conserve your time and your sanity by instantly discarding ideas that are fundamentally unknowable. You will free yourself from the tyranny of feeling like you need to understand everything. And in that freedom, you will find the clarity to go incredibly deep on the few simple, wonderful businesses that will actually build your wealth over time. This is not just an investment strategy. It is a philosophy for decision-making that will grant you an almost unfair advantage. It is the final promise of a simpler, more profitable, and more peaceful financial life. The concept that would eventually evolve into Warren Buffett's legendary too hard pile wasn't born in a flash of insight. It was forged in the crucible of market history, specifically during one of the most irrational and euphoric periods the world had ever seen, the dot-com bubble of the late 1990s. This was the moment that defined the principle, the moment where saying no was not just a strategy, but an act of profound courage against a tidal wave of public opinion. To truly understand the power of this idea, we must go back to that time. Imagine the world in 1999. The internet was a new frontier, a wild west of limitless possibility. Companies with little more than a catchy name ending in .com and a vague business plan were going public and seeing their stock prices multiply by 10, 20, even 100 times in a matter of months. A new generation of tech billionaires was being minted overnight. Financial news networks were a constant cacophony of hype, celebrating the new paradigm where old metrics like profits and revenues were dismissed as relics of a bygone era. It was all about eyeballs, clicks, and growth at any cost. And in the middle of this frenzy stood Warren Buffett and his partner Charlie Munger, the two old men from Omaha, looking like dinosaurs at a rave. Berkshire Hathaway, their investment vehicle, was dramatically underperforming the market. While the Nasdaq was soaring over 85% in 1999 alone, Berkshire's book value grew by a paltry 0.5%. The media, which had once lionized Buffett as a genius, turned on him with a vengeance. Barron's published a now infamous cover story titled, "What's Wrong, Warren?" The article suggested his time had passed, that his simple, value-oriented approach was obsolete in this new, fast-paced technological world. He was publicly ridiculed for his refusal to invest in the technology stocks that were making everyone else rich. He didn't own Microsoft, he didn't own Intel, he didn't own Cisco. He didn't own any of the high-flying internet darlings. The pressure was immense. Shareholders were grumbling. Pundits were mocking. It would have been the easiest thing in the world for Buffett to capitulate, to sprinkle a few tech stocks into the portfolio just to quiet the critics and participate in the gains. But he didn't. Instead, at the 1999 Berkshire Hathaway annual meeting, in front of thousands of shareholders and a skeptical press corps, he calmly and methodically explained his reasoning. He didn't say these companies were bad. He didn't predict they would fail. He said something far more powerful and far more instructive. He said, in essence, they were in his too hard pile. He explained his core principle of the circle of competence. He told his audience that everyone has areas of knowledge and expertise. For him, it was businesses like insurance, consumer goods, and media. He understood how Coca-Cola made money. He could reasonably predict what its business would look like in 10 or 20 years. He understood the durable competitive advantage of a brand that was seared into the minds of billions of people worldwide. But when it came to the new technology companies, he admitted he had no such clarity. He famously said, quote, "I don't know what the world will look like in 10 years, and I don't want to play in a game where the other guy has an advantage over me." He couldn't confidently predict which of the hundreds of competing tech firms would be the ultimate winner. He couldn't discern which ones had a genuine, lasting competitive advantage, and which were just riding the wave of euphoria. The entire sector for him was a black box. So he did nothing. He didn't spend months trying to become a tech expert. He didn't hire a team of analysts to build complex models. He simply acknowledged the boundary of his understanding and refused to step over it. He put the entire dot-com revolution into his too hard pile. This act of intellectual honesty was seen as weakness at the time, but it was the ultimate show of strength. He was running his own race, using his own scorecard. Of course, we all know what happened next. In March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal, gut-wrenching collapse. It would eventually fall nearly 80%, wiping out trillions of dollars in paper wealth. Companies that were once worth billions, like Pets.com and Webvan, went bankrupt and disappeared. The new paradigm was revealed to be the same old speculative mania that had occurred countless times throughout history. And while the rest of the world was panicking, Warren Buffett, with his massive pile of cash accumulated from not buying overpriced stocks he didn't understand, went shopping. The dinosaur had survived the meteor shower, and now he had the whole world to himself. The dot-com bust was the ultimate validation of the circle of competence and its practical application, the too hard pile. It proved that long-term investment success is not about being the smartest person in the room, but about being the most disciplined in knowing what you don't know. It cemented the idea that avoiding stupidity is a more reliable path to wealth than striving for genius. The immense pressure Buffett and Munger faced during the dot-com bubble reveals a deep-seated flaw in human psychology, a cognitive bias that the too hard pile is specifically designed to combat. This is the Dunning-Kruger effect, a phenomenon where people with low ability at a task overestimate their ability. It's the reason why the most incompetent people are often the most confident. In the investment world, this manifests as the, quote, amateur expert. A person reads a few articles about a new technology, watches a segment on financial television, and suddenly feels qualified to have a strong opinion on a complex company. They have climbed to the peak of what psychologists call Mount Stupid, a perilous perch where a little bit of knowledge creates a dangerous illusion of expertise. The retail investor who decides they can predict the outcome of a pharmaceutical company's Phase 3 drug trial is standing on that peak. The entrepreneur who thinks they can outsmart Wall Street analysts on a semiconductor company's supply chain is there too. The Dunning-Kruger effect creates an internal pressure to participate. To admit, "I don't know," feels like an admission of failure, especially when everyone around you seems to be getting rich. The media amplifies this effect. Financial news is not designed for sober, long-term decision-making. It's designed for entertainment and to generate clicks and ratings. It thrives on complexity, novelty, and the myth of the genius stock picker who can see the future. This creates another powerful psychological trap: the bias from over-influence from authority. When a well-dressed analyst on television confidently proclaims a certain tech stock is the next Amazon, our brain instinctively wants to believe them. They are the authority figure. This desire to trust experts is a useful shortcut in many areas of life, but in investing, where many so-called experts are really just salespeople in disguise, it can be fatal. Buffett's two-hard pile is a systematic defense against both of these biases. It is the physical embodiment of intellectual humility. By creating a formal process for saying "I don't know," he short-circuits the Dunning-Kruger effect. He is not trying to be an expert in everything. In fact, his entire philosophy is based on the idea that being an expert in just a few things is more than enough. He replaces the dangerous confidence of the amateur with the profound and profitable humility of the master. Furthermore, the pile acts as a filter against the noise of authority figures. The television pundit may be screaming "buy," but if the business model doesn't immediately make sense, if its future is not easily predictable, it doesn't matter what the expert says. The investment idea is summarily dismissed. It doesn't even get to the analysis stage. This isn't just about avoiding bad decisions. It's about preserving the mental clarity needed to make good ones. The brain is like a muscle. It gets tired. Trying to understand a business that is fundamentally outside your circle of competence is the cognitive equivalent of trying to lift a weight that is far too heavy. You strain, you struggle, and you ultimately fail, exhausting yourself in the process. The two-hard pile allows you to walk past the impossibly heavy weights and focus your strength on the ones you can lift with confidence. It's a recognition that your ability to make sound judgments is a finite resource, and the Dunning-Kruger effect is constantly trying to trick you into wasting it on problems you can't solve. So how do you translate this powerful psychological defense into a practical tool for your own investment strategy? How do you build your own two-hard pile? It begins with a process of rigorous self-examination, a mental blueprint for defining the boundaries of your own knowledge. This isn't a one-time exercise. It's an ongoing discipline, a core component of your portfolio management. The first step is to conduct a competence audit. Sit down with a blank piece of paper or a new document and be brutally honest with yourself. Make 3 columns. In the first column, list your profession, past and present. If you've been an accountant for 20 years, you likely have a deep, intuitive understanding of financial statements and the economics of professional services firms. If you're a software engineer, you understand the world of enterprise sales, software development cycles, and the competitive dynamics between tech giants. In the second column, list your deep, consuming hobbies. Not just things you dabble in, but things you've spent hundreds or thousands of hours on. Are you a passionate homebrewer who understands the entire supply chain from hops to distribution? Are you a car enthusiast who can break down the business models of Ford, Toyota, and Tesla? These areas of passion often translate into a real-world, ground-level understanding that no Wall Street analyst can replicate. In the third column, list industries in which you have been a long-time observant customer. Perhaps you've been a loyal customer of a specific bank for decades and understand its products and customer service inside and out. Maybe you're a parent who has spent a fortune on products from companies like Procter & Gamble or Disney. This isn't as strong as professional knowledge, but it provides a solid foundation. Once you have this list, You've created the preliminary map of your circle of competence. The next step is the information flow test. Pick an industry from your map. Now, go find its leading trade journal, something like American Banker for the banking industry, or Automotive News for the car industry. Can you read it cover to cover and understand 90% of what's being discussed? Do you instinctively know who the major players are, what the key variables for success are, like net interest margin for a bank or factory utilization for a car maker, and what the big challenges facing the industry are? If the answer is a resounding yes, that industry is firmly within your circle. If you find yourself lost in jargon and unfamiliar concepts, you're straying from your core. The third step is the explain it to a child test, the ultimate filter for clarity. Take a specific company within an industry you believe you understand. Can you, in less than 2 minutes, explain to an intelligent 12-year-old exactly how this company makes money and why its customers will still be buying its products or services 10 years from now? If you have to use complex jargon or convoluted explanations, you don't understand it well enough. A truly great business, a business that belongs in your easy pile, has a simple, elegant core. Coca-Cola sells sugar water with a powerful brand. See's Candy sells boxed chocolates that people buy for emotional reasons. BNSF Railway moves goods from point A to point B on a track that no one else can build. Simple. Understandable. Finally, you must draw the line. This is the most crucial step. Based on the previous exercises, you must explicitly write down the industries and business models that are tied outside your circle. Be specific. Biotechnology, semiconductor manufacturing, enterprise SaaS software with complex billing models, early-stage mining exploration. This list is not a sign of failure. It is your shield. It becomes the automatic trigger for your too hard pile. Whenever an idea comes across your desk, whether from a friend, a website, or a news report, your first action is to compare it against this list. If it's on the list, the decision is already made. It goes into the pile. There is no further research. There is no just taking a quick look. The case is closed. This disciplined process transforms the abstract concept of a circle of competence into a concrete, repeatable system for simplifying your investing life and dramatically improving your decision-making. To truly appreciate the wisdom of this approach, we must shine a harsh light on its opposite, the path walked by 99% of investors. This is the path of the dilettante, the person who mistakes breadth of knowledge for depth and activity for accomplishment. The typical retail investor today operates in a state of perpetual information overload. Their morning routine involves scanning headlines from a dozen financial websites, checking a stock tracking app on their phone, and scrolling through social media feeds where self-proclaimed gurus are pitching the next can't-miss opportunity. They feel a need to be an expert on everything. On Monday, they are trying to understand the geopolitical implications of oil prices. On Tuesday, they are deciphering the technical jargon in a new cryptocurrency white paper. On Wednesday, they are building a complex spreadsheet to model the future cash flows of a software company whose product they have never used. On Thursday, they are trying to get an edge on a biotech stock by reading summaries of clinical trial data. By Friday, they are exhausted, confused, and no closer to making a sound investment decision. This investor becomes a master of the shallow dive. They learn just enough about a company to feel the Dunning-Kruger effect kick in, giving them the false confidence to make a bet. They might know a company's revenue growth rate, but they don't understand the underlying drivers of that growth. They might have heard about a company's moat, but they can't clearly articulate why a competitor couldn't cross it. Their portfolio becomes a chaotic museum of the last 6 months of financial headlines. A little bit of crypto here, a struggling tech darling there, an electric vehicle startup, a cannabis stock. There is no coherent theme, no underlying philosophy, just a collection of disparate bets made with incomplete information. The consequences are disastrous. Because their knowledge is shallow, they have no conviction. When one of their stocks inevitably falls 20%, they panic. They don't have the deep understanding of the business to confidently determine if this is a temporary setback and a buying opportunity, or if the fundamental story has changed. Fear takes over. and they often sell at the bottom, locking in a loss. Conversely, when a stock they own doubles, they have no framework for deciding whether to sell and take profits or to let their winner run. They are adrift in a sea of random price movements, their decisions dictated by the twin emotions of fear and greed. This frenetic activity creates the illusion of control, but it is merely spinning wheels. It leads to high trading costs, unfavorable tax consequences, and, most importantly, a constant state of anxiety. The path of the 99% is a direct route to burnout and mediocre returns. It is the polar opposite of the calm, focused, and deliberate approach of using a too-hard pile to filter out the noise and concentrate only on what can be truly understood. The financial impact of this discipline, of religiously maintaining a circle of competence, is not abstract. It is quantifiable and massive. It manifests directly in the avoidance of catastrophic losses, which is mathematically the most important factor in long-term wealth creation. Let's create a tangible example from the very era that defined this principle. Imagine two investors in 1998, each with $100,000 to invest. Investor A is the typical investor of the time, the one following the path of the 99%. He's swept up in the dot-com mania. He feels foolish for owning old economy stocks. He decides to go all in on the future. He puts his $100,000 into a hot internet company. Let's call it Webvan. Webvan was a real company, a darling of the era, that promised to revolutionize the grocery business by delivering goods directly to customers' homes. It had a compelling story, massive media attention, and a soaring stock price. It was, however, a logistical nightmare with a fundamentally broken business model that burned through cash at an astonishing rate. Now consider Investor B. She operates with Buffett-like discipline. She looks at Webvan. The story is exciting, but she asks herself a few simple questions. Do I understand the incredibly complex logistics of last-mile delivery at scale? Can I confidently predict that this business will be profitable? Is this model truly superior to a traditional grocery store? The answers are no, and maybe, but it's uncertain. The future is unknowable. So she declares Webvan to be too hard. She sticks to what she knows. Let's say she has a deep understanding of consumer brands. She analyzes the Coca-Cola Company. The business is simple. It sells branded syrup to bottlers. Its competitive advantage is a global brand built over a century. Its future is highly predictable. People will likely be drinking more Coke, not less, in 10 years. The financial statements are solid and easy to understand. She buys $100,000 worth of Coca-Cola stock. Fast forward to the end of 2002. The dot-com bubble has burst. Webvan, after burning through over $1 billion in investment capital, has declared bankruptcy. Its stock is worthless. Investor A's $100,000 has gone to zero. A 100% permanent loss of capital. He has been wiped out. Meanwhile, Coca-Cola stock, while not immune to the bear market, has held its value far better and continued to pay its dividend. Investor B's position is worth roughly the same as what she paid, plus she has collected several $1,000s in dividends. Investor A didn't just lose money, he lost his most valuable asset, time. It would take a 100% return on his next investment just to get back to where he started. The power of compounding has been brutally reset to zero. Investor B, on the other hand, has preserved her capital. Her compounding machine is intact. The direct financial connection is this. The primary function of the too hard pile is to eliminate the possibility of a zero from your financial equation. By refusing to play games you don't understand, you dramatically reduce the odds of suffering a permanent, catastrophic loss from which it is mathematically difficult or impossible to recover. The financial statements of companies inside a circle of competence are almost always superior. They feature consistent profitability, high returns on capital, and low debt. The financial statements of companies in the too hard pile are often a mess of cash burn, mounting debt, and promises of future profits that may never materialize. The first group builds wealth slowly and surely. The second group destroys it with terrifying speed. The choice to say "I don't know" is the most profitable financial decision you can ever make. One of the most powerful and insidious psychological forces an investor will ever face is the fear of missing out, commonly known as FOMO. This single emotion is responsible for more bad investment decisions than perhaps any other. It is the voice in your head that whispers, "Everyone else is getting rich, and you're being left behind." It overrides logic, discipline, and common sense. It pushes you to abandon your well-thought-out strategy and chase after whatever is hot at the moment. The too-hard pile is a powerful tool, but it is useless if you lack the emotional fortitude to use it when FOMO is screaming at you. Warren Buffett's career provides a masterclass in conquering this destructive emotion. The greatest example of this was not just during the dot-com bubble, but in the years leading up to the 2008 global financial crisis. From roughly 2003 to mid-2007, the stock market was again on a tear, fueled this time by a housing bubble and reckless lending practices. Complex financial instruments like collateralized debt obligations, CDOs, and credit default swaps, CDSs, were all the rage on Wall Street. Private equity firms were executing massive leveraged buyouts, borrowing huge sums of money to acquire companies. It was a party, and credit was cheap. During this period, Buffett and Munger were once again criticized, though perhaps more quietly this time, for being too conservative. Berkshire Hathaway began to build up a massive cash pile. By the end of 2007, it was sitting on over $45 billion in cash and cash equivalents. In a bull market, holding cash is a cardinal sin. It earns next to nothing and acts as a drag on performance. Wall Street analysts and financial commentators questioned Buffett's judgment. Was he losing his touch again? Why wasn't he deploying this capital to participate in the boom? The answer was simple. The opportunities he was seeing were in his too-hard pile. He didn't fully understand the complex derivatives that were fueling the boom. He was deeply skeptical of the insane levels of leverage being used in private equity deals. He looked at the prices being paid for acquisitions and concluded they made no financial sense. The entire environment felt speculative and dangerous. So instead of succumbing to the pressure to do something, he did the hardest thing of all. He did nothing. He patiently waited, allowing his cash to build, knowing that his discipline was a form of offensive strategy. He wasn't just sitting on the sidelines, he was loading his elephant gun, waiting for the game to come to him. Then, in the fall of 2008, the world fell apart. Lehman Brothers collapsed. The credit markets froze. The global financial system teetered on the brink of collapse. Panic was everywhere. Fear was the only emotion left. And it was in this moment of maximum terror that Warren Buffett, the man who had been ridiculed for holding too much cash, became the lender of last resort to corporate America. In the span of a few weeks, he made two of the most brilliant deals of his career. First, in late September, he invested $5 billion in the embattled investment bank Goldman Sachs. This wasn't a simple stock purchase. It was a masterfully structured deal for preferred stock that paid a 10% annual dividend, plus he received warrants to buy common stock at a very attractive price. Weeks later, he made a similar $3 billion investment in General Electric. In early 2009, he provided crucial financing to Bank of America. These were not speculative bets. These were investments in cornerstone American institutions that he understood, made at a time when they were desperate for capital, and he was one of the few people who had any. He was able to dictate incredibly favorable terms because he had conquered FOMO during the boom years. He had endured the psychological pain of underperformance, the criticism of the media, and the temptation to join the party. His reward was the opportunity to buy wonderful businesses at prices no one could have imagined just a year earlier. He wasn't just buying stocks. He was buying a claim on the future earnings of the American economy at a moment of extreme pessimism. This entire episode is the ultimate testament to the power of emotional control in investing. The too-hard pile isn't just an intellectual filter, it's an emotional one. It's the discipline to say no when everyone around you is screaming yes, allowing you to preserve not just your financial capital but your psychological capital so that you can be the one to say yes when everyone else is screaming no. The intense desire to chase after what's popular, to participate in the mania, is not a character flaw, it's a deeply ingrained feature of our evolutionary wiring. For thousands of years, our survival depended on our ability to stick with the tribe. The person who saw the rest of the tribe running and decided to stand still was likely to be eaten by a saber-toothed tiger. This instinct is called herd behavior, or social proof. It's the cognitive shortcut our brain uses that says, if everyone else is doing it, it must be the right thing to do. In the modern world of investing, this ancient survival instinct is a catastrophic liability. When we see a stock like GameStop or Tesla soaring day after day, and we read stories online of ordinary people making life-changing fortunes, our brain's herd instinct kicks into overdrive. The feeling of being left out is not just a mild disappointment. It can feel like a genuine physical threat. This is the neuroscience of FOMO. It triggers the same primal fear centers in our brain that once protected us from predators. Resisting this urge requires immense conscious effort. Warren Buffett and Charlie Munger have spent a lifetime cultivating mental habits that act as a powerful countermechanism to this destructive instinct. The most important of these is the development of an internal scorecard. Most people in life, and especially in investing, operate on an external scorecard. Their sense of success and well-being is determined by what other people think of them. If the crowd praises them, they feel smart. If the crowd criticizes them, they feel stupid. An investor with an external scorecard is a slave to the market's whims. Their emotional state is tied to the daily fluctuations of their portfolio and the opinions of financial pundits. Buffett, by contrast, operates on an internal scorecard. He knows his principles. He trusts his own analysis. He has a clear definition of success that is completely independent of public opinion or short-term market performance. His success is based on whether he acted rationally, within his circle of competence, and with a long-term perspective. As he famously said, the big question about how people behave is whether they have an inner scorecard or an outer scorecard. It helps if you can be satisfied with an inner scorecard. The too hard pile is the primary tool for maintaining this internal scorecard. It forces you to define your own rules of the game. You are no longer trying to win the game that everyone else is playing, the game of chasing hot trends and speculating on things you don't understand. You are playing your own game, a game where the only rule is, do I understand this business inside and out? By externalizing the decision, by having a physical or metaphorical pile where you discard difficult ideas, you create a buffer between the stimulus of the market, the FOMO-inducing headline, and your response. It provides a moment of deliberate, rational thought to override the primal emotional panic. It allows you to calmly say, that may be a wonderful opportunity for someone else, but it is not a game I am qualified to play. This is the pinnacle of emotional discipline in finance. Developing this kind of Buffett-like immunity to FOMO is not something that happens overnight. It requires the deliberate practice of specific mental habits and the creation of a supportive environment. It's about re-engineering your decision-making process to favor discipline over impulse. Here is a practical, step-by-step blueprint for building your anti-FOMO mindset. The first and most critical step is to curate your information diet. FOMO is fueled by a constant stream of market noise. Your goal is to starve it. Unfollow the stock market hype accounts on social media. Cancel your subscription to the newsletters that promise, quote, hot stock picks. Turn off the financial news channel in your office. These sources are not designed to make you a better investor. They are designed to trigger your emotions and keep you engaged. Replace this junk food with nutritious, whole information. Your new diet should consist primarily of annual reports of companies you are interested in, industry trade journals from within your circle of competence, and timeless books on investment philosophy. You want to shift your focus from short-term price movements to long-term business fundamentals. Second, create an opportunity cost watch list. The feeling of FOMO comes from the sense that if you aren't buying the hot stock of the day, you are missing out on the only opportunity available. This is a fallacy. To combat it, create a list of 5 to 10 wonderful, high-quality companies that you deeply understand, but that are currently too expensive to buy. This could be companies like Costco, Hershey, or Microsoft. Track them, study them, know them inside and out. This simple act reframes your entire perspective. You are no longer thinking, "What am I missing out on?" You are now thinking, "What wonderful business am I patiently waiting for a chance to own?" Your cash position is no longer a symbol of inaction. It is a tool of patient opportunism. It is your dry powder, waiting for the fat pitch. Third, actively practice the mental model of inversion, a favorite of Charlie Munger. Whenever you feel the pull of FOMO, ask yourself, what would a foolish, FOMO-driven investor do in this exact situation? The answer is usually obvious. They would mortgage their house to buy the speculative asset at its peak. They would abandon their strategy. They would act on a hot tip from a questionable source. Once you've clearly defined the path of foolishness, your path becomes clear. Do the opposite. Inversion is a powerful way to use the madness of the crowd as a compass pointing you toward rational behavior. It's a cornerstone of effective risk management. Finally, you need to quantify your patience and discipline. At the end of each month or quarter, when you review your portfolio, don't just look at your returns. Add a section to your journal titled Discipline Report. Write down the speculative ideas you successfully avoided. Note the times you felt the urge to chase a stock and resisted. Celebrate these moments of inaction. Frame them as victories. By consciously acknowledging and rewarding your own discipline, you create a positive feedback loop that strengthens your emotional fortitude over time. You are training your brain to associate good feelings with rational, patient behavior, rather than the fleeting, dangerous thrill of the chase. This comprehensive system, controlling your information, reframing your opportunities, inverting the problem, and rewarding your discipline, is how you build a psychological fortress against the destructive power of FOMO. The allure of FOMO is so powerful that a look at its victims provides a chilling lesson in what not to do. The path of the 99% is littered with the financial wreckage caused by succumbing to herd behavior. We don't have to look back to the dot-com bubble for an example. A perfect case study occurred with the GameStop and AMC meme stock mania of early 2021. This was FOMO in its purest, most concentrated form. Here you had two businesses with deeply troubled fundamentals. GameStop was a brick-and-mortar video game retailer in a world rapidly shifting to digital downloads. AMC was a movie theater chain crippled by a global pandemic. By any rational measure of value investing, these were businesses to be avoided. But the fundamentals didn't matter. A narrative took hold, primarily on social media platforms like Reddit's Wall Street Bets forum. It was a story of David versus Goliath, of retail investors banding together to fight back against villainous hedge funds that were shorting the stock. The story was intoxicating, and it went viral. Millions of new, inexperienced investors downloaded trading apps like Robinhood and piled in. They saw the stock price of GameStop rocketing from under $20 to over $480 in a matter of weeks. They saw screenshots of people turning a few $1,000s into hundreds of thousands. The herd instinct was triggered on a global scale. The fear of missing out was palpable. People who had never bought a stock in their lives were suddenly all in. They weren't making an investment. They were buying a lottery ticket, fueled by a powerful cocktail of greed and social proof. They didn't understand the complex market mechanics of a short squeeze. They didn't analyze the company's balance sheet. They simply saw a line going up and felt an overwhelming compulsion to be a part of it. The outcome was predictable. The professionals, the hedge funds, and the early retail investors who understood the dynamics cashed out near the top. The latecomers, the FOMO-driven crowd who bought in at prices above $200, $300, or even $400, were left holding the bag. The stock price inevitably collapsed, falling back below $50 in the subsequent weeks. Billions of dollars in wealth were transferred from the pockets of the impulsive to the pockets of the disciplined. The social media forums that were once filled with triumphant posts were now filled with tragic stories of people who had lost their life savings, their college funds, their retirement accounts. This is the antithesis of the Buffett approach in every conceivable way. It was a decision made with zero regard for the underlying business value. It was driven entirely by an external scorecard. The desire to be part of a social movement and to achieve quick, effortless wealth. It was playing a game that was not only too hard, but was fundamentally rigged against them. The GameStop saga is a perfect, modern illustration of why conquering FOMO is not just a helpful tip, it is a matter of financial survival. The direct financial connection between conquering FOMO and building wealth is stark and undeniable. Let's illustrate this with a tale of two portfolios over a 10-year market cycle, which includes both a bull market and a significant crash. Investor A is the FOMO chaser. Investor B is the disciplined operator. Both start with $100,000. In the early years of the bull market, Investor A is aggressive. He chases the hot tech stocks and makes impressive gains, let's say 25% per year for 3 years. His portfolio grows to nearly $195,000. Investor B, the disciplined operator, finds very few opportunities that meet her strict criteria of simplicity and value. She remains 50% in cash, and her portfolio of steady, boring companies grows at a modest 8% per year. After 3 years, her portfolio is worth only about $126,000. By all external measures, Investor A is a genius and Investor B is a fool. Investor A feels smart and emboldened. In year 4, a speculative bubble forms around a new technology. Let's call it quantum computing. Investor A, high on his past success and terrified of missing out on the next big thing, goes all in. Investor B looks at quantum computing and immediately throws it in her too hard pile. She continues to hold her boring stocks and a large cash position. For a while, Investor A looks brilliant as the bubble inflates. But in year 5, the bubble bursts. The quantum computing sector collapses by 80%. Investor A's portfolio, which had swelled to over $300,000, plummets to just $60,000, a catastrophic loss. Over the same 2 years, Investor B's portfolio has continued to chug along at 8% annually, now sitting at around $147,000. Now the market crashes. A broad-based panic ensues. Investor A is emotionally shattered and financially crippled. He has no cash to deploy and is too scared to do anything but sell at the bottom to preserve what little he has left. Investor B, on the other hand, sees this as the opportunity she has been patiently waiting for. Her internal scorecard is validated. She takes her large cash pile, which now represents significant buying power, and begins buying the wonderful companies on her watch list at 50 cents on the dollar. In the subsequent market recovery over the next 5 years, her now fully invested portfolio compounds at a healthy 15% per year. At the end of the 10-year cycle, Investor B's portfolio is worth over $400,000. Investor A, who was forced to sell near the bottom and only cautiously re-entered the market later, is lucky if he has gotten back to his original $100,000. This is the financial reality of emotional discipline. The investor who avoids the big mistake, who resists the siren song of FOMO, will almost always outperform the brilliant but impulsive speculator over the long term. The cash held during the boom years wasn't a drag on returns. It was a call option on future bargains. The decision-making process that looked foolish in the short term was revealed to be profoundly wise in the long term. This is how real wealth is built, not by chasing the highs, but by having the discipline and the capital to take advantage of the lows. Warren Buffett's office in Omaha is famously simple. There's no Bloomberg terminal flashing stock quotes, no wall of monitors tracking global markets. What you will find are books, annual reports, and something even more valuable, an almost completely empty calendar. Buffett has structured his entire life around the preservation of his most valuable and non-renewable resource, his time and the mental bandwidth that comes with it. He estimates that he spends as much as 80% of his working day just sitting and reading and thinking. This is not an accident. It is the core of his operational strategy. He has said, "I insist on a lot of time being spent, almost every day, to just sit and think." That is very uncommon in American business. I read and think. So I do more reading and thinking and make less impulse decisions than most people in business. This approach is the complete opposite of the modern executive or Wall Street trader, whose schedule is a back-to-back marathon of meetings, phone calls, and frantic activity. Buffett understands a profound truth. High-quality decision-making, the kind required for intelligent capital allocation, cannot happen in a state of perpetual busyness and distraction. It requires long, uninterrupted blocks of time for deep thought. The too-hard pile is the primary mechanism that protects this precious resource. Every investment idea that comes across his desk is a potential thief of his time. A complex biotech company could require hundreds of hours of study to even begin to understand. A rapidly changing technology firm would demand constant monitoring and re-evaluation. By immediately discarding these ideas, by saying no in the first 5 minutes, he is not being lazy, he is being a ruthless manager of his own cognitive assets. He is refusing to let low-probability bets drain his energy reserves. A perfect illustration of this principle in action was his long-held investment in the Washington Post Company. He first invested in 1973. What he loved about the newspaper business as it existed then was its simplicity and its durable competitive advantage. A city like Washington, D.C. could really only support one dominant newspaper. This created a local monopoly, a fortress that was almost impossible for a competitor to assail. This was a business he could understand completely. More importantly, it was a business that didn't require constant, frantic decision-making. The management team, led by Katharine Graham, was excellent. The business model was stable. Buffett could buy the stock, read the quarterly and annual reports, and then go back to his reading, confident that the business was taking care of itself. He didn't need to worry about a disruptive new technology every 6 months or a sudden shift in consumer behavior. He bought a wonderful, simple business and then had the discipline to let it work for him, freeing up his own time to search for the next great opportunity. This is the hidden genius of the too-hard pile. It's not just an investment filter, it's a time management system. It's a declaration that your mental energy is your most valuable capital, and you will not squander it on puzzles that are fiendishly difficult or impossible to solve. You will save it for the rare, simple, obvious opportunities where deep thought can produce extraordinary results. The wisdom of Buffett's empty schedule is backed by a wealth of modern psychological research. The key principle at play is known as decision fatigue or ego depletion. This theory posits that our ability to make sound, rational judgments is a finite resource, like a muscle that gets tired with overuse. Every single decision we make throughout the day, from what to wear in the morning to what to eat for lunch, drains a small amount of this mental energy. When this resource is depleted, we become cognitively tired. We start to look for shortcuts. We become more impulsive. We are more likely to make a poor choice or, alternatively, to suffer from analysis paralysis and make no choice at all. Now, apply this concept to the world of investing. The investor who refuses to use a too-hard pile is subjecting themselves to a relentless barrage of complex decisions. Should I try to understand this new software company? Should I research this cryptocurrency? Should I build a model for this pharmaceutical firm? Each one of these initial should-I questions depletes their cognitive reserves. If they decide to proceed, the subsequent research, reading dense technical documents, trying to predict competitive dynamics, forecasting uncertain future growth, drains their decision-making battery even further. By the time an actual, simple, high-quality opportunity comes along, they may be too mentally exhausted to recognize it, or to act on it with the conviction it deserves. They have wasted their best mental energy on the hardest problems, leaving only cognitive scraps for the easy ones. The too hard pile is a systematic defense against decision fatigue. It is a pre-commitment to conserve your mental firepower by creating a strict rule. If I don't understand it within 5 minutes, I discard it. You eliminate hundreds of potential low-quality decisions from your day. You are essentially automating the act of saying no. This is not an act of ignorance, it is an act of profound self-awareness. It is the recognition that you have a limited number of high-quality decisions you can make in a given day or week. The central question for any serious investor is, on what problems will I expend that precious resource? Will you spend it trying to predict the price of oil, the direction of interest rates, or the winner of the electric vehicle race, all fiendishly complex problems with thousands of variables? Or will you, like Buffett, conserve that energy for a small number of questions that you are uniquely qualified to answer, such as, will people still be drinking Coca-Cola in 20 years? Or, does this insurance company have a disciplined underwriting culture? The choice you make on how to allocate your cognitive budget will have a greater impact on your long-term financial success than any other single factor. The too hard pile is the most effective budgeting tool ever invented for the serious investor. To implement this principle effectively, you need to move beyond the abstract idea and create a concrete system. This is the mental energy budgeting system for investors, a blueprint for allocating your cognitive resources with the same discipline you would use for your financial capital. The first step is to track your time. For 1 full week, keep a detailed log of every minute you spend on activities related to investing. This includes reading financial news, checking your portfolio, researching new ideas, and talking about stocks with friends. Be brutally honest. At the end of the week, you will have a clear picture of where your time is actually going. The second step is to categorize that time. Go through your log and assign each activity to one of 2 buckets: circle of competence or exploratory. Circle of competence activities are those that deepen your understanding of an industry or company you already know well. This could be reading the annual report of a company you own, studying a competitor's strategy, or reading a trade journal for that industry. Exploratory activities are everything else. This is the time you spend trying to understand a new, complex industry, reading about a hot stock you know nothing about, or falling down a rabbit hole of speculation. The third step is to apply the 80-20th rule. Look at your categorized time log. For most investors, the ratio will be shocking. They spend 80% or more of their time in the exploratory bucket, chasing novelty and complexity, and less than 20% in the circle of competence bucket, deepening their actual expertise. Your goal is to flip this ratio on its head. You must make a conscious commitment that from this point forward, at least 80% of your dedicated investment time will be spent within your predefined circle of competence. This is a non-negotiable rule. The too hard pile is the enforcement mechanism for this rule. It is the tool that keeps the exploratory time from hijacking your schedule. The fourth and final step is to develop a ruthless 5-minute filter. This is the gatekeeper for any new idea that tries to enter your mental space. When you hear about a new company, give yourself a strict 5-minute time limit to assess it. In those 5 minutes, your only goal is to answer one question. Is this business simple, and does its basic model make sense to me? If it's a company like Domino's Pizza, you can probably answer yes in 30 seconds. It sells pizza for a profit. Simple. If it's a company that uses artificial intelligence to optimize pharmaceutical supply chains, the answer is almost certainly no. As soon as you determine the answer is no, the idea immediately goes into the too hard pile. The research is over. You do not pass go. You do not collect $200. You move on with your life, your precious mental energy intact. This system, track, categorize, apply the 80-20th rule, and filter, transforms the management of your time from a passive, reactive process into a deliberate, proactive strategy. It ensures that your most valuable asset is deployed where it can generate the highest possible return. The path of the 99% is the path of the busy investor. This individual mistakes activity for progress and motion for forward momentum. Their desk, both physical and digital, is a monument to cognitive chaos. They have 30 browser tabs open at all times. One is a live stock chart, another is a crypto exchange. A third is a news article about the Federal Reserve. A fourth is a deep dive into the technical specifications of a new microchip. They subscribe to a dozen different newsletters, each one promising an exclusive insight or a hot pick. Their email inbox is a constant flood of alerts and analysis. They spend hours watching financial television, listening to the conflicting opinions of pundits who are paid to be confident, not to be right. This investor is always tinkering. They can't leave their portfolio alone. They are constantly buying a little of this, selling a little of that, rebalancing, trimming, and adding. They believe that this constant activity makes them a more diligent and responsible investor. In reality, they are like a nervous cook who keeps opening the oven door to check on the cake. Their meddling prevents it from ever rising properly. The psychological toll of this approach is immense. They are a victim of profound information overload. Their brain is so saturated with disparate data points that it becomes impossible to see the big picture. They lose the forest for the trees. Furthermore, they are in a constant state of decision fatigue. By lunchtime, their capacity for making sound, rational judgments has been completely exhausted by 1,000 tiny, insignificant analytical tasks. Their afternoon decisions are therefore far more likely to be impulsive, emotional, and wrong. They might sell a good company on a bad news headline or buy a speculative stock on a whim, simply because they are too mentally tired to conduct a proper analysis. They live in a state of low-grade, persistent anxiety, always worried that they are missing something, that some piece of news they haven't seen yet will tank their portfolio. This is not investing. This is a high-stress, low-reward job that they have created for themselves. It is the absolute antithesis of the calm, focused, and thoughtful environment that Buffett has cultivated, an environment where deep work is possible and where time is an ally, not an enemy. The financial connection here is best understood through the concept of return on time invested, or ROTI. Every investor has two budgets: a financial budget, how much money they can invest, and a cognitive budget, how much time and mental energy they can invest. Most people only think about the return on their financial investment. Great investors are obsessed with the return on their cognitive investment. Let's consider two scenarios. In scenario A, an investor decides to research a complex and unpredictable airline stock. The airline industry is notoriously difficult. Its profitability depends on dozens of variables that are impossible to predict: the price of jet fuel, the state of the economy, geopolitical events, labor relations, and intense competition. To gain even a small analytical edge in this industry, our investor would need to spend, let's say, 100 hours of intense effort. They would need to build complex financial models, study fleet maintenance schedules, and track global travel trends. After all that work, their edge might be tiny, perhaps giving them a slightly better than 50-50 chance of being right. Their return on time invested is abysmal. The potential financial reward is low relative to the immense cognitive cost. In scenario B, the investor uses the too hard pile. They immediately discard the airline stock. Instead, they decide to spend their time researching a simple, predictable business within their circle of competence. Let's say it's a dominant consumer brand, like McCormick, the spice company. The business is simple. The future is predictable. People will continue to cook with spices. The competitive position is strong. To gain a massive analytical edge on this company, our investor might only need to spend 20 hours. They can read the last 10 annual reports, study the brand's market share, and talk to a few grocery store managers. With this focused effort, they can develop a very high degree of confidence in the company's long-term prospects. Their return on time invested is huge. The cognitive cost is low, and the probability of a good financial outcome is high. The too hard pile is a mechanism for systematically rejecting low ROTI activities and forcing you to focus on high ROTI activities. It dramatically improves the efficiency of your research process, By saying no to the 99% of ideas that are complex and time-consuming, you free up the resources to do a truly world-class job of analyzing the 1% of ideas that are simple and understandable. This is how a single individual, the retail investor, or the dedicated entrepreneur can achieve results that are superior to many large, bureaucratic financial institutions. Those institutions are often forced to have an opinion on everything, spreading their analytical resources thin. The individual has the power to choose their own game, to focus their mental firepower with laser-like precision on the most fertile ground. That choice is the source of a massive and sustainable financial advantage. If the too hard pile is the tool for filtering out 99% of investment ideas, then what are the characteristics of the 1% that pass through the filter? What does an easy game look like? To answer this, we must travel back to 1972, to a deal that Warren Buffett and Charlie Munger have said taught them more about business than almost any other. This was their acquisition of a small, family-owned chocolate company based in California, See's Candies. On the surface, See's was an unremarkable business. It made and sold high-quality, old-fashioned boxed chocolates. There was no cutting-edge technology, no massive global scale, no complex financial engineering. It was, in a word, simple. And that was precisely what attracted Buffett and Munger to it. At the time, their investment strategy, inherited from their mentor Ben Graham, was focused on buying statistically cheap, cigar-butt companies, fair businesses at a wonderful price. See's Candies was different. It was being offered for $25 million, a price that was about 3 times its book value. This was not a statistically cheap stock. But as they examined the business, they saw something special. First, the product itself was simple and timeless. Chocolate is not a technology that is going to be disrupted. People had been enjoying it for centuries, and would likely continue to do so for centuries more. Second, the company had a powerful, albeit regional, brand. In California, giving a box of See's Candies was a tradition for holidays, birthdays, and special occasions. The brand was associated with quality, nostalgia, and affection. This created immense customer loyalty. Third, and this was the crucial insight, this brand loyalty gave See's incredible pricing power. They discovered that customers were not particularly price-sensitive. If See's raised its prices by 10% to cover rising costs of sugar or cocoa, customers didn't blink. They paid the higher price because they weren't just buying chocolate, they were buying a feeling, a tradition. This pricing power meant the business was a wonderful machine for generating cash, a machine that could protect itself against the ravages of inflation. Fourth, the business required very little additional capital to grow. It didn't need to build massive, expensive new factories or spend billions on research and development. Growth could be funded from its own profits. This combination of factors, a simple product, a loyal customer base, pricing power, and low capital requirements, made See's a truly wonderful business. Buffett and Munger realized that it was far better to pay a fair price for a wonderful business like See's than to get a bargain on a mediocre, difficult business. The See's Candies deal was a revelation. It taught them that the best investments are often found in the easy pile, in businesses so simple and so good that you can understand their entire economic engine in a few hours. It shifted their focus from spreadsheets and valuation metrics to the more qualitative, but far more important, questions of competitive advantage and long-term durability. It became the template for what they would look for in the future: businesses that were easy to understand, easy to run, and easy to love. The human brain, for all its marvels, has some strange biases when it comes to assessing problems. One of the most pervasive is the complexity bias. We have an unconscious tendency to believe that complex solutions are better than simple ones. We are more impressed by the analyst who builds a 100-tab spreadsheet than the one who can explain a business on the back of a napkin. We assume the doctor who uses a lot of technical jargon is smarter than the one who explains our condition in plain English. This bias is a trap for investors. It leads them to be drawn to complex companies and complex strategies, believing that this is where the smart money is made. They are seduced by the intricate narratives of biotech firms, the technological wizardry of semiconductor companies, and the convoluted financial models of Wall Street. They dismiss simple, boring businesses as unsophisticated. Warren Buffett's entire philosophy is a rebellion against this bias. He actively seeks out boring. He understands that in investing, simplicity is a massive competitive advantage. A simple business is easier to understand, which means it's easier to value and harder to make a major mistake with. This approach also short-circuits another dangerous mental shortcut, the availability heuristic. This is our tendency to judge the likelihood of an event by how easily examples come to mind. Because the financial media is constantly talking about the latest hot tech stock or the most dramatic market news, these ideas are highly available in our minds. We start to believe that these are the only things that matter. The quiet, steady, boring company that has been compounding wealth for 50 years, like a spice company or a paint manufacturer, gets no media coverage. It is not readily available to our minds, and so we underweight its importance. The too hard pile is a systematic tool to counteract both of these biases. It forces you to reject complexity in favor of simplicity. It filters out the noisy, available ideas that the media is pushing and encourages you to look for the quiet, overlooked opportunities. Buffett is not looking for a puzzle to solve. He is not trying to prove how smart he is by untangling a complex mess. He is looking for a game that is so easy that he is almost guaranteed to win. By consistently choosing the simple over the complex and the understandable over the arcane, he sidesteps the cognitive traps that ensnare the vast majority of investors. To make this practical, you need a systematic way to score potential investments for simplicity. This is the Buffett Simplicity Scorecard, a checklist you can use to determine if a company belongs in the easy pile or the too hard pile. For any new idea, run it through these 4 tests and score it on a scale of 1 to 10 for each, where 10 is highest simplicity and 1 is lowest. First is the business model test. Score 1 to 10. The question is, can I explain how this company makes money in a single, simple sentence without using industry jargon? For a company like McDonald's, the answer is a clear 10. They sell fast food and beverages for a profit and own valuable real estate. For a complex financial institution that deals in derivatives, the score might be a 1 or 2. If you can't easily explain it, you don't understand it. A high score is essential. Second is the 10-year test. Score 1 to 10. The question is, how confident am I that I know what this industry and this specific company will look like in 10 or 20 years? For a company like Hershey, the score is a 10. It is highly probable they will still be the dominant seller of chocolate bars in North America. The product, the competition, and the consumer will not have changed dramatically. For a new social media company, the score might be a 2. The competitive landscape is brutal and constantly shifting. Will they even exist in 10 years? A high score here indicates a predictable, durable business. Third is the idiot test, as Buffett famously puts it. Score 1 to 10. The question is the business so good, with such a strong competitive advantage, that even a mediocre manager can't mess it up? A company with a powerful moat, like the railroad BNSF, with its irreplaceable track network, gets a 10. Its success is not dependent on a genius CEO. A company that is entirely reliant on the vision of a single brilliant founder gets a lower score. What happens if that founder leaves or makes a major mistake? You want to invest in businesses, not in miracle workers. Fourth and finally is the input dependency test. Score 1 to 10. The question is, does the company's success depend on a few simple, predictable variables, or on 1,000 complex, unpredictable ones? A company like See's Candies depends mostly on the price of sugar and cocoa and its brand loyalty. That's a 9 or a 10. A global automaker, on the other hand, depends on steel prices, currency fluctuations, international supply chains, government regulations, labor negotiations, and technological shifts. That's a 2 or a 3. The fewer moving parts, the less that can go wrong. Once you have scored a company on all 4 tests, add up the total. A score of 35 or higher means you have likely found an easy game, a simple, understandable, durable business worthy of deep analysis. A score below 25 means the company should go directly into the too hard pile, no matter how exciting its story may seem. This scorecard provides a disciplined, unemotional framework for filtering opportunities and focusing your energy where it matters most. The antithesis of this simplicity-seeking approach is the investor who is drawn to the most difficult games imaginable. Consider the amateur investor who decides to specialize in early-stage biotechnology companies. This is, without a doubt, one of the hardest games in the entire stock market. To succeed here, you are not competing against other amateurs. You are competing against teams of PhDs, medical doctors, and professional venture capitalists who have spent their entire lives in this field. The path of this investor is one of extreme difficulty. They spend months trying to understand the science behind a single drug. They must learn about molecular biology, gene sequencing, and the intricacies of the human immune system. Then, they must become an expert in the regulatory process, deciphering the complex phases of FDA clinical trials. They must understand patent law and the dynamics of intellectual property. Even if they master all of this, the outcome for any single drug is still a binary, unpredictable event. It either works and gets approved, or it fails, rendering the company's stock virtually worthless. The investor builds elaborate spreadsheets, modeling the potential market size for the drug and making dozens of assumptions about pricing, adoption rates, and competition. But the entire model, the product of hundreds of hours of work, can be rendered completely useless by a single data point from a clinical trial. They are playing a game of intellectual poker where they have very few good cards and their opponents can see their hand. They are attracted to the massive potential upside, the dream of finding the next 100 bagger, but they consistently underestimate the massive probability of a total loss. They have chosen to climb the Everest of investing without oxygen or a guide, simply because the view from the top is rumored to be spectacular. This is a path of hubris. It violates every principle of the easy game philosophy. The business model is not simple. The 10-year future is completely unknowable. The company's success depends entirely on brilliant scientists and favorable regulatory outcomes, not a durable moat. And its success hinges on 1,000 highly complex and unpredictable variables. It is the quintessential resident of the too hard pile. The profound difference between an easy game and a hard game is not just philosophical, it is written in the cold, hard numbers of their financial statements. Let's compare the financial profile of a simple, durable business like Hershey with that of a speculative, pre-revenue biotech company. When you look at Hershey's income statement, you will see a picture of beautiful predictability. Revenue grows slowly but steadily, year after year, like a gently rising tide. The cost of goods sold is a stable percentage of revenue. The company is consistently, handsomely profitable, with operating margins that are wide and stable. There are no wild swings, no sudden surprises. Now look at its balance sheet. You will see a fortress. The assets are simple to understand. Factories, inventory, and a massive intangible asset called goodwill, which represents the power of its brand. The debt levels are manageable and supported by a mountain of predictable cash flow. Now contrast that with the financial statements of our speculative biotech firm. The income statement is a sea of red ink. There is little to no revenue. The expenses are enormous, primarily driven by massive spending on research and development. The company is losing hundreds of millions of dollars every year. This is not a business. It is a science experiment funded by investor capital. The balance sheet is equally terrifying. The primary asset is cash. The company is not generating cash. It is burning it, hoping to reach a breakthrough before the money runs out. There is often no debt, not because the company is conservative, but because no bank would be foolish enough to lend it money. Its survival depends on its ability to continually sell more stock to new investors, diluting the ownership of the existing shareholders. Looking at these two sets of financial statements side by side is a powerful lesson. The simplicity of Hershey's business model translates directly into the quality, predictability, and strength of its financials. The complexity and uncertainty of the biotech's business model translates directly into a financial profile that is fragile, unpredictable, and entirely dependent on hope. The too hard pile is, at its core, a system for keeping you away from the second type of financial statement and focused squarely on the first. It is a risk management tool of the highest order. There is a powerful and often misunderstood concept in the world of long-term investing. It is the idea that the secret to winning is not about making brilliant moves but about consistently avoiding stupid ones. Charlie Munger articulated this perfectly when he said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." The too hard pile is the ultimate system for being consistently not stupid. It is a discipline that, when practiced over a lifetime, compounds into an almost insurmountable advantage. The most dramatic illustration of this principle is the story of the fall of long-term capital management, or LTCM, in 1998. This was not a firm run by amateurs. Its boardroom was a collection of the most brilliant minds in finance. It included two Nobel Prize-winning economists, Myron Scholes and Robert Merton, whose work on options pricing was the theoretical bedrock of modern financial engineering. It also included John Meriwether, the legendary former head of bond trading at Salomon Brothers. These were, by any definition, the smartest guys in the room. Their strategy was impossibly complex. They used highly sophisticated mathematical models to identify tiny, temporary pricing discrepancies in global bond markets. They would then use massive amounts of leverage, borrowing over $25 for every $1 of their own capital, to make enormous bets on these discrepancies converging. For a few years, it worked spectacularly. They generated returns of over 40% annually. They were hailed as geniuses, the new masters of the universe. Warren Buffett, meanwhile, was running Berkshire Hathaway with his simple, old-fashioned principles. He was buying See's Candies and Coca-Cola. He admitted he didn't understand the complex arbitrage strategies that LTCM was using. For him, their entire business model would have gone straight into the too hard pile. Then, in 1998, the unforeseen happened. Russia defaulted on its government debt, and a subsequent flight to safety caused the pricing discrepancies that LTCM was betting on to widen dramatically instead of converging. Their models, which had assumed a normal bell curve distribution of outcomes, failed to account for a black swan event. Because of their extreme leverage, their losses were catastrophic. In a matter of weeks, the firm lost over $4.6 billion and was on the brink of collapse, threatening to take the entire global financial system down with it. The Federal Reserve had to orchestrate a massive bailout, ironically calling on Warren Buffett himself to consider participating. The story of LTCM is the ultimate cautionary tale. It proves that intelligence, even genius-level intelligence, is no substitute for wisdom and discipline. The Nobel laureates at LTCM were trying to be very intelligent, and in doing so they made a monumentally stupid mistake. Buffett, by contrast, spent his entire career just trying to not be stupid, and in doing so he built one of the greatest fortunes in human history. The too hard pile is the mechanism that separates these two paths. It is the humility to admit that some games are too complex and too dangerous to play, no matter how smart you think you are. That humility, compounded over decades, is the true source of wealth. The reason that avoiding stupidity is so much more powerful than seeking brilliance lies in the brutal and unforgiving mathematics of loss, a psychological principle known as loss aversion. Groundbreaking research by psychologists Daniel Kahneman and Amos Tversky, for which Kahneman won the Nobel Prize, proved that for most people, the psychological pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. This is a crucial insight for investors. A large loss doesn't just damage your portfolio. It inflicts a deep psychological wound that can lead to a cascade of further bad decisions. An investor who suffers a 50% loss on a speculative bet often becomes paralyzed by fear. They may swear off stocks forever, missing the subsequent recovery. Or they may engage in revenge trading, making even riskier bets in a desperate attempt to win their money back quickly, almost always leading to further losses. The too hard pile is the ultimate defense against this destructive cycle. It is a system designed to manage your psychological capital just as much as your financial capital. By refusing to invest in businesses you don't fully understand, you dramatically lower the probability of suffering the kind of catastrophic permanent loss that triggers a severe loss aversion response. When you own a portfolio of simple, understandable, profitable businesses, a 20% market downturn feels different. You understand what you own. You have confidence in the long-term earnings power of your companies. Instead of feeling panic, you are more likely to feel a sense of opportunity. You are psychologically prepared to stay the course, or even to buy more, because you have not been emotionally scarred by a devastating loss in a business you never should have owned in the first place. Staying in the game is the most important prerequisite for allowing the miracle of compounding to work its magic. Compounding requires two things: a decent rate of return and a very long period of time. A single, massive loss can destroy the time variable of that equation, forcing you to start over. The discipline to say no to difficult, unpredictable ideas is the discipline that keeps you in the game, allowing your wealth to grow, year after year, decade after decade, in a steady, uninterrupted, upward march. To truly internalize the long-term benefits of this discipline, you need to create a feedback loop that constantly reinforces the wisdom of your inaction. This can be achieved through two powerful exercises: the creation of an anti-portfolio and the practice of keeping a post-mortem journal. First, create your anti-portfolio. Every time you throw an investment idea into your too hard pile, write it down. Create a simple spreadsheet or a note in a journal. List the date, the name of the company, and a one-sentence reason why you discarded it. For example, February 15th, Palantir Technologies. Too hard because I cannot simply explain their business model or identify their durable competitive advantage. This list will become an incredibly valuable learning tool. Once a year, schedule time to review your anti-portfolio. Look at what happened to the companies you chose to avoid. A few of them may have gone up significantly, and it's important to acknowledge that. You will miss some winners. That is an acceptable cost of this strategy. But what you will likely find is that a great number of them have gone down, gone nowhere, or have been on a terrifying roller coaster ride that would have caused you immense stress and likely led you to sell at the worst possible time. This annual review will provide concrete, personal evidence of the value of your discipline. It will quiet the voice of regret over the winners you missed by showing you the minefield of losers you successfully navigated. Second, conduct a rigorous post-mortem on every single investment mistake you make. We all make them. When a stock you own goes down significantly and you decide to sell, do not just move on. Force yourself to sit down and write out a detailed analysis of what went wrong. The most important question to ask is this: did this mistake happen because I strayed from my circle of competence? Was this truly an easy game that I misjudged, or was it a hard game that I foolishly convinced myself I could win? Be brutally honest. More often than not, you will find that your biggest losses came from investments that, in hindsight, should have been in your too hard pile from the very beginning. By documenting these failures and their root cause, you train your brain to recognize the warning signs in the future. This journal of mistakes becomes a personalized textbook on what not to do. Over time, the combination of the anti-portfolio, celebrating your wise omissions, and the post-mortem journal, learning from your foolish inclusions, creates a powerful, self-correcting system that will continuously refine and strengthen your financial discipline. The final destination for the investor who ignores this discipline is a place called gambler's ruin. This is a mathematical concept that demonstrates how even with favorable odds, a series of negative outcomes can lead to a total loss of capital if one is betting too large a portion of their bankroll on any single outcome. The investor who constantly plays in the too hard pile is essentially a gambler, taking big swings on low probability, high uncertainty bets. They might get lucky once or twice. They might hit a five-bagger on a speculative tech stock or a crypto coin. This early success is the most dangerous thing that can happen to them because it reinforces all the wrong habits. It teaches them that research is for suckers and that fortune favors the bold. They develop a sense of invincibility. Emboldened by their luck, they take an even bigger swing on the next can't-miss idea they don't truly understand. But eventually, the laws of probability and business economics catch up to them. They invest a huge portion of their portfolio in a company whose future is unknowable, and that company fails. They suffer a catastrophic loss, 50%, 70%, even 90%. The portfolio they spent years building is decimated in a matter of months. Their financial journey, which should look like a steady, upward-sloping hill, instead looks like a jagged mountain range, with thrilling peaks followed by terrifying, gut-wrenching valleys. The problem is that once you fall into one of those deep valleys, it is almost impossible to climb out. They have become a victim of the brutal math of loss. This is the path of the 99%. It's a path of excitement, of great stories to tell at cocktail parties, but it rarely leads to genuine, lasting financial freedom. It is a constant cycle of boom and bust, of hope and despair. It is the polar opposite of the steady, quiet, and inexorable compounding of wealth that comes from a lifetime of being consistently not stupid. Let's conclude by etching the direct financial connection of this principle into our minds with a final, simple mathematical example. Imagine two investors, both starting at age 25 with $10,000. Investor A follows the path of discipline. She uses the too hard pile religiously, avoids speculation, and builds a portfolio of simple, wonderful businesses that generates a steady, boring, but consistent 10% annual return. Investor B is the gambler. He chases hot tips and plays in hard games. His returns are a roller coaster. In his first year, he gets lucky and makes 40%. In his second year, he makes another 20%. He feels like a genius. But in his third year, he gets caught in a speculative bust and loses 50% of his entire portfolio. Let's look at the numbers. At the end of year 3, Investor A, with her boring 10% returns, has turned her $10,000 into $13,310. Now for Investor B. His $10,000 grew to $14,000 in year 1. That $14,000 grew to $16,800 in year 2. He was far ahead. But then came the 50% loss. Half of $16,800 is $8,400. At the end of year 3, despite his brilliant start, he has less money than he began with. He has fallen behind the boring, disciplined investor, and it is now almost mathematically impossible for him to ever catch up. That single, catastrophic loss, the direct result of playing a game he didn't understand, has shattered the power of compounding. The too hard pile is not just a quaint idea or a folksy piece of Buffett wisdom. It is the single most powerful system ever devised to prevent that minus 50% year from ever appearing on your financial ledger. And preventing that year is the true, unglamorous, and deeply profound secret to achieving long-term financial freedom. You have just spent this time acquiring not just a piece of information but a powerful mental tool. You now possess the single most effective filter used by the greatest investor in history to protect his capital, his time, and his sanity. This concept of the too hard pile, this discipline of saying no, is the foundation upon which all durable wealth is built. It is the shield that will protect you from the noise, the hype, and the foolishness of the market. But a shield is a defensive weapon. This filter is only the first, crucial stage. It tells you what to avoid. It clears the battlefield of distractions. But the real genius, the part that builds fortunes, is in what happens next. How do you analyze the small number of opportunities that actually pass this rigorous test? How do you confidently determine what a great business is worth? How do you know when to buy? That requires a completely different yet interconnected set of mental models. It's a framework for offensive action, a blueprint for intelligent aggression that connects directly to the discipline you've just learned. The video that is now appearing on your screen is the next piece of that framework. Think of what you've just learned as the map of the minefield. That next video is the schematic for the treasure chest. It is the bridge from what to ignore to what to buy. It takes the focused attention you now know how to cultivate and weaponizes it, turning it into a precise tool for valuation and action. Most people will stop here. They will be satisfied with knowing how to say no, feeling that they have learned enough to be safe. But you are not most people. The very fact that you have come this far proves that you are part of a small minority committed to true mastery. The decision to continue is not about watching another video. It is a declaration. It is a commitment to building the complete mental arsenal required for financial sovereignty. Do not leave the job half finished. Complete the map. Click and continue your ascent.